Welcome to video 3, sponsored by the town of Vic Park around business improvement. So what we're looking at today is, in this episode, is how you get your business structures and the different structures that exist for setting up your business. So video 1 was assessing your business idea, episode 2 was presenting your business plan, and now you're going, well, what structure works for me? So look, these are things you have discussions with your accountants and lawyers to make sure these are appropriate, but let's go through the basics. So the most common structure for most people is a sole trader, and a sole trader is effectively you operating as yourself. So you are the legal person running the business and you're responsible for it. Then there are these other structures, which I'm going to illustrate by going through a tablet diagram. So look, I'm not an artist, guys, but we'll do our best to explain how these things work. So let's get to it.
All right, so look, you've probably heard of a company, and a company is a fairly common structure for a lot of businesses. And the way you sort of have it is we have one over here, and it's called a PTY Ltd, and that's because it's a private limited company. So look, if you're an unlisted or a public company, which means you're on the ASX, if you're a public company, or if you're an unlisted company, you've got a certain threshold. So vast majority of Australian businesses would be, if they're set up as a company, are a PTY Ltd company. And this goes back to the good old days where a company is a separate legal entity. And what that basically means is that entity is by law treated as if it was a person. So if something was to go wrong, the company is the entity that gets used up its assets. So going back to that example of the insurance not covering you, and you've got to pay a claim of $5,000 or $20,000 for damages you've caused, the assets of the company are the only assets available to be accessed, unless you breach company director rules and you've done something that you shouldn't have per the before ASIC. Otherwise, the company's assets are the only assets allowed to be used. So your house and your cash that's outside here, outside, is safe. And that's the reason people sometimes set companies. Now, there are some other benefits where tax rates are lower, but again, tax rates being lower means it could be offset by the money has to come back to you. So there's a whole bunch of rules that you have to be wary of, and you speak to your accountant about them. They include PSI rules, professional services allocations. There's a whole bunch of things you've got to really be careful of. So again, not going to go through those today. That's for you to discuss with your accountant. So a PTY Ltd is a way to do it. The company tax rate at the moment is 25%, but look, if the money comes back out to you as an individual or the shareholder, they will pay tax at their rate. So that's all the stuff in front of you as potential issues to look at. So I suppose, look, there's advantages of the company. The other extra benefit of a company is, look, if you're one of those few businesses that can qualify for a research and development grant, you need to be set up as a company to do that. So look, if you need to find out more about research and development, feel free to Google and go to the government business.gov.au website, which runs through the R&D offset or claim, and so does the ATO. So those are great resources about doing that. And you do see a specialist accountant to go through doing an R&D claim. That's probably companies for you. So look, to sum it up, benefits. It's a separate legal entity, so your assets can be more protected than otherwise if you're a sole trader. Does come with more costs. You've got to pay money to set up the company. You've got to pay annual costs to an accounting and ASIC to keep it maintained. So there's more costly to do it, again, but it might be the right structure for you depending on the type of business you are trying to run. So the next structure we're going to look at right now is a family trust. So look, going back a step from before, you can have a family trust operate a business too. Now, your family trust could also be a shareholder of the company, and that we'll get to the advantages of doing that now. So a family trust is a way of a shareholder that basically follows the rules of a trust deed. So there's a deed that will govern the rules. On top of that, the family trust has to also have someone that runs it, and that's what we call a trustee. So if you hear the term trustee, that's the person that runs the trust. Again, if you want that trustee, who's the person running the trust, to have that separate legal protection, you want a company as a trustee. Or it can be an individual. But if you have it as an individual, that means it's effectively the same protections as you had as a sole trader. So if the debts of the business fall over, the trustee may have to come back and pay through it. So that's why most people have a company as the trustee. So again, more costs involved. But the family trust has the advantages of, and this is subject to Section 100A and other tax laws, how it distributes that income to other beneficiaries. So you could distribute the money between, a husband and wife. The trust deed will also potentially let you distribute to other parties. And again, you need to go through that with a lawyer and an accountant to understand your trust deed, what you can distribute to. So it could potentially be able to distribute to investment companies or other companies related to, could also be kids. But again, the ATO has more stricter rulings and views on these transactions. So again, sit down with your accountant and understand more about it. Section 100A has made it very clear, and professional allocation of services and things like that. There's a whole bunch of things out there that are making it more stricter on what you do in the family trust and what rules and tests you have to pass. So again, this is one of those times you do see professionals to go through it. But a family trust is a more flexible environment to distribute income from your business. Those are probably the two most common structures that we've gone through, which were the company and the family trust. The last one is probably a little bit less common, but I think it's an important one to go through with people. So now the one thing I probably didn't cover in before with the company and the trust is the losses that you run in your business. So let's say you run the business and unfortunately you run a loss, and those losses get stuck in the business. So you can't use them against your income. Well, if you're a sole trader, as long as you pass the income threshold, so you had enough sales, you could use those losses against your other income to reduce your tax. Now, those losses aren't lost. It just means when you make profit in the future, you can use up those losses in that time. But if your business gets closed or you stop it, you've lost the money you've set up to run the business. So unfortunately, that's one thing you do have to be aware of. All right, so the last structure we're going to go through is probably a little bit less common, but it does get used in a few businesses. It's called a unit trust. So a unit trust, a fixed unit trust, is similar to a company in the sense you can have different shareholders in it, and you can have different unit holders in there. The big difference, in my mind, with a unit trust is than a company. So a company has, you still have a trustee, and in this case, I would, generally you would recommend you have a company as a trustee for that separate legal entity. But then the unit trust distributes its profits to all the different shareholders, or unit holders in this case. So very similar to a share in a company. The big difference in a unit holder situation is you might have a few shareholders in your company in the business, but we have this thing called retained profits. So let's say you've made $100,000 in profits, you've paid some tax on it at that tax rate. Let's say it's 25%, and you're not a high turnover, so you're not paying 30%. You pay the 25%, then you're left with 75 grand in the business. Some of the shareholders will want access to that money. Some people won't, and sometimes you're actually having a dispute with your fellow partners because someone wants a dividend and someone doesn't because of tax consequences. And that happens, and that problem becomes bigger and bigger as time goes on because your company builds more and more profits. So you end up with a potential tax problem because you've decided to go down that structure. So what a unit trust does is if you make that $100,000 in profit, everyone gets their share of the profit. So, let's say this person owns 40%, they'll get $40,000, and then they'll pay their own tax bill on it. So, if that's a family trust or if that's someone as a sole trader or individual, they'll pay the tax in their own name. Then you got someone here that owns 30, they'll get 30 grand. and they'll pay their tax on their 30 and 30. Now, you might be saying, what if the business still needs that money to run through? That's okay. You can lend that money back, and it'll show on the financials that the business still owes you money. You've decided to lend the money back, but you still have the money to pay your tax bill. What this does is it avoids that argument or the potential dispute going, well, you haven't paid tax on it. You paid tax on it in your own name, and then you've thrown the money back. So after tax, this person might only put $15,000 back in. This person might put 15 as well, and this person might put 20,000 back into the business. But everyone's paid their tax, and we go through and we keep running. So really important, because the last thing you want to do is a delayed tax problem or a dispute causing your business not to grow. So I quite like the unit trust opposed to a company if you've got multiple shareholders, just because of this potential dispute and issue over how you treat profits in the business. That means everyone's tax problems, person A, person B, and person C's tax problems are not the company or the business's problem. So that's probably the other structure that some people go ahead and set up. All right, thank you for enjoying these 3-part series with the Town of Vic Park on how to analyse your business, go through a business plan, and how to structure it. If you have any questions, reach out to the local Small Business Development Corporation or business.gov.au or your local advisor. Thank you.